Okay, so you've joined us again for another deep dive, and this time we're going to be looking at the Q4 FY25 earnings report from Tata Consultancy Services, or
Yeah.
TCS.
TCS, as most folks know it. Yeah.
Exactly. Yeah. We've got a pretty big stack of information here. We've got the earnings report itself. Of course, we've got notes from some pretty sharp analysts at Nomura, Goldman Sachs, Jefferies, and UBS. And we're also going to be taking a look at some of their historical share price data.
Trying to make sense of it all.
Exactly.
Right.
Yeah. And really, our mission today is to kind of go through all of this stuff, pull out the really, really important pieces, and hopefully give you a really clear, concise understanding of where TCS stands today, and maybe where they might be headed.
The big picture.
The big picture, exactly, yeah. And we're going to be touching on some stuff that will probably really make you think, we've got significant new deal wins, but we've also got a pretty cautious outlook for the future. There's a deferred salary hike, and we've got a pretty wide range of opinions from analysts, so there's a lot to unpack here.
Absolutely. And we want to go beyond just the numbers.
Yeah.
What do they actually mean when we look at what the analysts are saying and the broader kind of economic landscape?
Yeah.
Consider this your cheat sheet to getting smart on TCS's latest performance,
Right.
and how the experts are reading it.
Okay, so let's dive right in, and we'll start with the kind of headline numbers from Q4 FY25. Revenue came in at 64,479 crore rupees, which is a pretty solid 5.2% jump year on year.
Healthy?
Yeah, so that's compared to the same quarter last year, of course.
Yeah.
And a more modest 0.7% increase quarter on quarter, so compared to the last 3 months. And it looks like that top line figure pretty much landed right where everyone expected it to.
That's right. Revenue was basically in line with expectations, as the report itself notes.
Okay.
But if we look at net profit, that's where we see a bit of a different picture. TCS reported a net profit of 12,224 crore for the quarter. Still a huge number.
Big number, but it's down 1.6%, year on year, and also a 1.2% dip from the previous quarter.
Okay.
So what's important to note here is that the earnings report explicitly states that net profit figure was lower than what analysts were anticipating.
Uh-huh.
So they're bringing in the revenue, but their profitability seems to be taking a bit of a hit.
So a bit of a mixed bag then, revenue doing what it's supposed to be doing, but that bottom line not quite keeping up.
Yeah.
We also see an operating margin of 24.2% and a net margin of 19% for the quarter. And looking at the full fiscal year, FY25, their total revenue hit 255,324 crore rupees, marking a 6% year-on-year growth.
Okay.
So overall trajectory upwards in terms of, bringing money in, but definitely some pressure on how much of that they're keeping as profit, especially in that last quarter.
Precisely. And it's really important to understand where that revenue growth is coming from.
Yeah. The Indian market stands out massively with a 33% year-on-year growth.
Wow.
Following that, we have Middle East and Africa showing strong growth, 13.2%. Latin America and Asia Pacific contributed 4.3% and 6.4% respectively.
Okay.
And those figures are in constant currency terms,
Right.
which helps give a clearer picture by removing the impact of exchange rate fluctuations.
Yeah, that's a really good point. And it's striking to see that domestic market just leading the charge by so much.
Huge difference.
It is, yeah. There's a pretty stark contrast.
Yeah.
Massive growth domestically, while other key regions are growing at a more moderate pace.
Yep.
What about the different industries that they serve?
Sure.
Which sectors are really fueling this growth?
So the earnings report highlights that the growth was primarily supported by the energy resources and utility sector,
Okay.
which saw a 4.6% year-on-year increase, and then BFSI,
Right.
banking, financial services, and insurance,
Yeah.
which grew by 2.5%.
Okay.
These have traditionally been strong areas for TCS, so their continued contribution isn't entirely surprising.
Right.
But it does underscore their strength in these domains.
Yeah, for sure. Okay, so we've got a pretty good handle on the numbers now, but what about what's driving future performance?
Right.
I saw some really impressive figures on new deal wins.
Yes.
That's got to be a key indicator, right?
Absolutely. Here's where it gets really interesting for understanding their future trajectory.
Okay.
TCS reported a record $12.2 billion in new deal wins
Wow, that's massive.
in Q4 FY25.
Okay.
That's a significant number, and it translates to a book-to-bill ratio of 1.6.
Now, for those who might not be familiar, can you break down what that book-to-bill ratio means?
Certainly.
For you, the listener.
Yeah.
Why should you care about that number?
Think of it this way. The book-to-bill ratio is like a health indicator for future revenue.
Okay.
It essentially compares the value of new contracts they've signed, the bookings.
To the amount of revenue they've actually recognized during that same period.
Right.
The billings.
Gotcha.
A ratio above 1, like the 1.6 TCS reported signals strong demand.
Okay.
It means they are bringing in more new business than they are currently delivering and getting paid for.
Right.
So this is generally a positive sign suggesting a healthy pipeline of future work and potential for revenue growth down the line.
Makes sense.
For the full fiscal year, their total order book stands at a very healthy $39.4 billion.
That's a huge number.
Yeah.
That sounds encouraging. And the report mentions some specific big wins, right? Putting some names to those billions always helps to make it feel less abstract.
Yes, exactly. It makes it more tangible when you see who they're partnering with,
Right.
They've secured deals with Muscat Clearing and Depository to modernize their systems.
Okay.
The Cumberland Building Society to upgrade their core banking infrastructure.
Okay.
A contract for end-to-end IT transformation for UPM.
An extended partnership with DNB Bank ASA and a 5-year deal with Air New Zealand to modernize their digital infrastructure.
Wow. Those are some big names.
Yeah.
Like a pretty wide range of industries.
Substantial clients across different sectors, yeah.
Yeah, it suggests a pretty broad range of capabilities and continued strong demand for their services.
Sure.
So on the one hand, we've got these record deal wins pointing to a potentially bright future.
Right.
But earlier we noted that their profit margins were a bit of a miss.
Yeah.
And that feels like a bit of a contradiction with what's going on there.
Yeah.
How do these two things reconcile?
That's a crucial question.
Yeah.
Their operating margin missed expectations by about 60 basis points.
Okay.
Now, a basis point is 1/100th of a percentage point, so 60 basis points is 0.6%.
Okay.
Might sound small, but for a company the size of TCS, it represents a significant amount of potential profit.
Right.
The management commentary in the earnings report provides some clues as to why this might be happening. They mentioned that the decision-making cycle in certain sectors started to slow down beginning in February, and this has had an impact on their growth and potentially the speed at which they can start billing for those new deals.
So it sounds like clients are becoming more hesitant to commit fully or are taking longer to finalize projects,
Yeah.
which could delay the revenue from those impressive new deals from actually hitting their bottom line.
Precisely. And this uncertainty seems to be cascading into other areas of their operations as well. Perhaps the most notable is the decision to defer the wage hike for FY26.
Oh, wow.
They're citing the growing macroeconomic uncertainty, particularly the ongoing tariff war between the U.S. and other countries, as the primary reason for this delay.
A deferred salary hike for a company of TCS's size with its massive workforce, that's pretty significant.
It is.
What does that tell us about their immediate outlook and what kind of impact could that have on their employees?
It certainly signals a more cautious approach to managing their costs. In the face of this economic uncertainty for their employees, it understandably means a delay in any expected increases to their compensation.
Right.
Which could potentially affect morale and even their competitiveness in attracting and retaining talent in the long run.
Right, for sure.
For the company itself, it's a direct lever they can pull to try and manage their cost structure.
Yeah.
In an environment where the certainty of future revenue growth might be less clear.
Makes sense.
Even with those strong deal wins.
Yeah.
It's also worth noting the CEO's comment that if this tariff uncertainty persists, we could see continued delays in discretionary spending by their clients. They've already observed delays in the ramp-up of projects as clients wait for more clarity on the economic front.
It paints a picture of a somewhat hesitant market overall, despite those impressive headline figures for new business.
Yeah.
Now, let's shift gears a little bit and talk about talent.
Okay.
PCS is one of the largest employers in the IT services space.
Huge.
What did the report say about their hiring plans and employee attrition?
They plan to hire around 42,000 engineers from campuses in FY26, which is on par with their hiring numbers in FY25.
Wow.
In the fourth quarter of FY25 alone, they added a net of 625 employees.
Okay.
And for the entire fiscal year, their total headcount increased by 6,433, which is a notable turnaround from the decrease they saw in the previous year.
Right.
On the attrition front, The rate at which employees are leaving the company inched up slightly to 13.3% in Q4 FY25 from 13% in the prior quarter.
It feels a little paradoxical, doesn't it? Announcing major plans for bringing in fresh talent from campuses,
Yeah,
while simultaneously deciding to defer salary hikes for their existing workforce.
right.
It almost sends conflicting messages about their priorities and their confidence in the near term.
You've hit on a key tension there, and it's something to think about.
Yeah.
The continued large-scale campus hiring likely serves a dual purpose. It ensures a steady pipeline of talent for future growth needs. And it can also help manage overall salary costs, as entry-level salaries are typically lower than those of more experienced professionals.
Makes sense, yeah.
The deferred salary hike for their current employees, on the other hand, really underscores the more immediate concerns they have about profitability and navigating these macroeconomic headwinds.
Yeah.
It's a balancing act between investing in long-term growth and managing the cost pressures they're facing right now.
Yeah, it is for sure. The report also mentioned some significant changes in their leadership team. Can you tell us about those appointments?
Yes, there have been 2 key appointments that were announced.
Okay.
Arthi Subramanian has been named the new COO Executive Director and President, and she took on that role effective May 1st.
Okay.
She brings a wealth of experience from Tata Sons, where she was the Chief Digital Officer leading digital technology and innovation initiatives across the entire group. Additionally, Mangesh Sath has been appointed as the Chief Strategy Officer. He was previously the CEO of Tata Strategic Management Group, and in his new role will be responsible for leading their global consulting practice and overseeing mergers and acquisitions.
Wow, so some pretty significant changes.
Big shoes to fill.
Yeah, the CEO mentioned that these appointments are part of a broader strategic exercise.
Yeah.
What's your take on what these leadership changes might signify for the company's direction?
The CEO's explanation that these appointments are aimed at strengthening their capabilities in key technology areas and building strategic partnerships makes a lot of sense.
Yeah.
Especially when you consider the rapid pace of technological change in the IT services industry.
Right.
Bringing in leaders with strong backgrounds in digital transformation, strategic thinking, and M&A suggests that TCS is looking to bolster its ability to capitalize on those significant deal wins we talked about earlier, and to navigate the evolving technological landscape potentially through strategic acquisitions or partnerships.
Right.
It's a signal that they're focused on future growth and adapting to the changing market dynamics.
Okay, now let's turn our attention to what the analysts are making of all of this.
Okay.
We've got insights from several major financial firms.
Right.
What are the key takeaways from their perspectives on TCS's performance and future outlook?
We're seeing a range of reactions from the analyst community, which is quite common after earnings reports.
Yeah.
Nomura, for example, has maintained a neutral rating on TCS, but has lowered their price target for the stock to 3,490 rupees.
Okay.
Their rationale is that they observed more misses than hits in this particular quarter, particularly concerning the profit figures, and they've expressed some concern about the clarity of their growth prospects for the current fiscal year, FY26. As a result of this more cautious outlook, they've also revised down their earnings per share estimates for the next 2 fiscal years by 2 to 3%.
Okay.
They also point out that the stock is currently trading at a multiple of around 21.4 times their estimated EPS for FY27.
So Nomura seems to be adopting a more cautious stance, reflecting some of the concerns that we've already discussed. What about Goldman Sachs? What's their take?
Goldman Sachs has maintained a buy rating on TCS, which is a more positive signal.
Yeah, okay.
But they, too, have decided to reduce their price target, bringing it down to 3,960 rupees.
Okay.
They highlight the uncertain growth outlook that was indicated by the management's commentary during the earnings call, as well as the relatively flat headcount in the last quarter and the decision to defer the wage hike.
Right.
As factors contributing to this slightly more tempered outlook.
Okay.
Consequently, they've also trimmed their revenue estimates for FY26 and FY27 by about 3%.
Gotcha.
They specifically noted the delays in client decision-making,
Yeah.
the slower ramp-up of new projects, and the increased scrutiny on discretionary IT spending that TCS is currently observing in the market.
I think Jefferies has a hold rating on the stock, if I'm remembering correctly.
Yeah, that's right.
What's the basis for their perspective?
Jefferies has a hold rating with a price target of 3,300 rupees.
Okay. Their analysis emphasizes the ongoing pressures on discretionary IT spending by clients.
Right.
and the delays in decision-making processes, which they believe will likely limit both the revenue growth and the potential for margin expansion for TCS in the near term.
Makes sense.
As a result, they've also lowered their EPS estimates for the fiscal years 2026 through 2028 and are anticipating an average EPS growth rate of around 8% during that period.
Okay.
Their overall view is that while the downside risk for the stock might be limited at its current valuation, the upside potential is also likely capped until they see a more significant and sustained improvement in U.S. GDP growth, which is a key market for TCS.
Gotcha. Okay. And finally, let's look at what UBS is saying among the analysts we're focusing on. They seem to be the most optimistic about TCS's prospects.
UBS has indeed maintained a buy rating on TCS and has the highest price target among this group at 4,250 rupees.
Okay.
They acknowledge the management's comments regarding deal deferrals.
And the slower decision-making in certain segments of the market. However, they emphasize that they continue to see robust momentum in deal wins, particularly within the North American BFSI sector.
Okay.
Specifically, excluding the insurance subsegment.
Okay.
This suggests they believe TCS is well-positioned to capitalize on opportunities in this key vertical despite the broader economic uncertainties.
So it's a real mix of opinions from these major analyst firms.
Yeah.
It seems like the record deal wins are definitely being seen as a positive sign for the future.
Right.
But the prevailing concerns about the macroeconomic environment and its potential impact on client spending are weighing on their near-term outlooks.
Understandably.
And their expectations for the stock.
Yeah.
Albeit to varying degrees.
Yeah.
What's the overall sentiment among the broader analyst community?
Sure.
Take a wider look.
The earnings report itself provides a useful snapshot of that broader sentiment.
Okay.
Out of the 48 analysts who are currently covering TCS, a significant majority, 34 still have a buy rating on the stock.
Okay.
11 analysts have a hold rating indicating a more neutral stance.
Gotcha.
And only 3 analysts have a sell rating suggesting a negative view.
Okay.
So while there are certainly concerns being raised and some downward revisions to price targets, the overall sentiment from the analyst community still leans towards a positive view of the company's long-term potential.
That provides some helpful context.
Yeah.
Now, let's turn our attention to the actual performance of TCS's stock in the market.
Sure.
We have share price data going back to May 2022. What does that historical trend tell us about how the market has viewed TCS over this period?
Looking at the share price trend from May 2022 to November 2024, we observe a period characterized by volatility and sideways movement until around the middle of 2023.
Okay.
From that point, the price began a noticeable upward trend, eventually reaching a peak in the vicinity of 4,400 to 4,600 rupees around May of 2024. However, subsequent to that peak in May 2024, there was a sharp decline in the share price, bringing it down to a level of around 3,400 rupees by November 2024.
That peak in the share price around mid-2024 does seem quite significant, especially when followed by such a sharp drop. Are there any specific factors that might have driven that particular movement?
The report itself notes that these kinds of price fluctuations can be influenced by a multitude of factors, including broader market conditions,
Of course.
any company-specific news or announcements that were made around that time,
Right.
as well as macroeconomic trends and investor sentiment.
Yeah.
Without conducting a more in-depth analysis of specific events that occurred during that period, any explanation would be somewhat speculative.
Right.
However, the shift in the overall trend from upward to downward after May 2024 is quite evident in the data.
Yeah, for sure. The information we have also mentions some moving averages, specifically the 50-day moving average, or DMA, and the 200-day moving average.
Right.
What's the significance of these technical indicators for someone trying to understand the stock's movement?
These moving averages are commonly used tools in technical analysis. To help identify the trend of a stock price, the 50-day moving average essentially reflects the average price of the stock over the past 50 trading days.
Okay.
Giving an indication of the short-term trend, the 200-day moving average, on the other hand, reflects the average price over the past 200 trading days
Okay.
and provides a picture of the longer-term trend.
Gotcha.
The report points out that the 50 DMA closely followed the price movements, showing the upward trend leading up to May 2024 and then the subsequent decline.
Okay.
The 200 DMA showed a more gradual upward slope, suggesting a longer-term bullish trend that also appears to have been disrupted after May 2024.
Gotcha.
Importantly, the report mentions the occurrence of a death cross around mid-2024.
Interesting.
This is a technical analysis term that refers to the 50 DMA crossing below the 200 DMA. And it's often interpreted by some investors and analysts as a potential signal of weakening momentum and a possible shift towards a more bearish or negative trend for the stock, although it's not always a definitive predictor of future price movements.
Right, of course. And what about the price-to-earnings ratio, or PE ratio? How has the market been valuing TCS relative to its earnings over this period?
The PE ratio for TCS hovered around its median PE ratio of 30.2 for a significant portion of the period between May 2022 and mid-2024.
Okay.
This might suggest that the market was valuing the company in a way that was largely consistent with its historical average, or perhaps slightly optimistic during that time. The peak in the share price around mid-2024 saw the PE ratio climb above this median, indicating a premium valuation at that particular point.
Okay.
However, the more recent decline in the share price has brought the PE ratio down to a range of 24 to 26, which is noticeably below its historical median. This could be interpreted in a couple of ways. It might suggest that the stock is currently trading at a discount compared to how it has been historically valued.
Right.
Or it could also reflect the market's more cautious outlook given the various economic and company-specific uncertainties that we've been discussing.
So if we try to synthesize all this information, it seems that the share price performance and the valuation metrics we're looking at really do mirror the mixed picture that's emerging from the company's earnings report itself and the various analyst perspectives we've examined.
Exactly.
Strong past performance and a period of optimistic valuation were followed by a more uncertain outlook, which is reflected in a declining share price and a lower PE ratio.
The market appears to be reacting to the combination of those strong new deal bookings, which signal future potential, but also the significant concerns that remain regarding the broader macroeconomic environment, the potential for delays in those deals translating into actual revenue, and the consequent impact on the company's profitability in the near to medium term. The analysts' revised price targets also largely reflect this more cautious near-term outlook, even while a majority of them still maintain a longer-term positive view on the fundamental strength of TCS.
Okay, so to wrap things up for you, our listener here, are the key takeaways from this deep dive into TCS's latest earnings and the expert opinions surrounding it. For the fourth quarter of FY25, we saw a mixed bag while revenue slightly exceeded expectations. Net profit fell short. Despite securing a record amount of new business indicating strong future potential, there's clear pressure on their profit margins and a more cautious outlook being communicated by the company's management, perhaps most clearly signaled by the decision to defer salary hikes.
Right.
The analysts we looked at also presented a somewhat divided picture, with many still optimistic about TCS's long-term prospects, but also acknowledging the near-term headwinds and in some cases revising their expectations downwards. Interestingly, this cautious near-term outlook coexists with continued plans for significant hiring, suggesting a focus on longer-term growth.
And as you can see by pulling together information from the company itself, expert financial analysts and historical market data, you get a much more nuanced and comprehensive understanding of the situation than you would from just looking at a few headline numbers. You gain insights into the underlying dynamics, the key concerns, and the potential opportunities that a major player like TCS is currently navigating.
So here's a final thought for you to consider. Given the very strong record of new deal wins that TCS has achieved, alongside the undeniably uncertain macroeconomic environment that they and their clients are operating in, what factors do you think will ultimately be the biggest determinants of TCS's performance and success in the coming year?
It's a good question.
Or perhaps, how should you interpret the apparent divergence between those very strong bookings which suggest future growth and the rather significant decision to defer salary hikes for their existing employees, which signals a focus on managing costs right now?
Right.
It's definitely something to think about as you consider the future of this major IT services company.
Lots to watch for.
Definitely lots to watch for.
Absolutely.
Thanks for joining us for another deep dive.
It's been a pleasure.
We'll see you next time.
See you later.